Thank you very much. Good morning, everyone. Welcome. Glad you could be with us today. I'm certainly happy to be here. This morning, I would like to talk about options, one of my favorite parts of trading. When I got familiar with options, it completely changed my trading for the better, and I hope it does the same for you. So this is our Crush the Market with Options presentation. As Renee said, I'm Vince Vora. I'm the head trader here at Trading Wins. I've been doing this for a little over 30 years, and over that period have designed several strategies and systems, and I'm actually going to share a couple of strategies with you today as well. For today's presentation, I'd like to start off with some of the option basics, the true basics, you know, what a call is, what a put is, a few of the terms that you need to be aware of, and then we'll get into some of the strategies. We will also talk about who is it that actually makes money in the market and on which side of the market with options. And then, as I mentioned, I'll share a couple of different option strategies with you this morning. Hopefully we'll have some time to answer your questions as well. Please do remember that trading can be risky, so don't trade with real money until you are completely comfortable with the system you are using. So let's start off with call options. And call options, here's the textbook definition. What call options do is give you the right, but not the obligation. And that's a key point here, not the obligation. I'll explain as we go through this. It gives you the right to buy a specific amount of stock at a specific price, which we call the strike price, anytime from the time that you buy that option until the expiration date. Okay. The option seller, however, would be obligated to sell you that stock at that specific price when and if you do exercise your option. So the key things to remember when you're buying a long option, so be it a call or a put, which we'll talk about in a moment, whenever you are the buyer, whenever you're going long the option, your profit potential can be unlimited because the stock theoretically can continue to go up all the time, but your loss is always limited to the amount that you paid for the option. So this is a key point when it comes to options trading, because it is one way that you can control the amount of risk you take. If you only want to risk $200 a share, for example, and the option costs $2, you know, you buy one contract and that is all you can ever lose, no matter what happens with the underlying stock. Okay, key point to remember. If you're short that option, it's actually quite the opposite. Your profit potential is always limited to the premium you receive for selling that call. So again, if that call was worth $2 and you sold one contract, you'd receive $200, and that is the maximum profit you can make, but your potential loss would be unlimited because, again, theoretically, the strike, the underlying stock price can continue to rise. Okay, put options are basically the opposite of calls. They give you the right to sell a specific amount of stock at a fixed price, known as the strike price, again, anytime from the date that you buy that option until it expires. And put options are used mostly for protection. In one of the strategies that I'm going to be talking about today, I'll show you exactly how you can do that. They're very useful. It's something you definitely want to be familiar with and trade with. They're fantastic. But if you're, once again, the seller of the option, you then would be obligated to buy that stock from the other party at that specified strike price if and when they decide to exercise that option. So again, if you're long the put, if you're the buyer of the put, then your profit could be significant because it will increase as that underlying stock price makes its way to zero. Okay, it's not unlimited like the calls, because in this case the stock would be going in the opposite direction and can never be worth less than zero. but your potential loss is similar to the calls, is limited to the amount that you originally paid for that contract. So again, if you're the buyer, you can never lose more than what you pay for that option, okay, which is a key point. If you're short, of course, your profit potential is limited to the premium that you receive for the sale of that put. But your loss can be significant, again, because it will increase as that stock makes its way to zero. Okay, so options premium is one of the terms you must be familiar with when you're trading options. And what it means is, first of all, I'll say that one option contract is the equivalent of 100 shares of underlying stock, okay? And so, for example, if you're buying one call option at $1.50, the way you calculate it is to multiply the $1.50 times 100, right? So it'd be 1 for the number of calls you have, times 150 times 100 would equal $150, okay? If you had bought 10 call options, that's the equivalent of 1,000 shares. So it'd be 10 times 150 times 100, it would end up being $1,500 if you were doing it that way, okay? But again, the key point is you can never lose more than what you pay for it, no matter how or what happens to that underlying stock. You can never lose more than what you pay for. What type of options can you buy? There's thousands of optionable stocks out there now. Not only do they have monthly expirations, but now there's hundreds, if not thousands, with weekly expirations. Stock indices. So you can buy an option on an index, like the S&P 500, like the NASDAQ, like the Dow, for example. On futures, you can buy an option on things like crude oil, gold, wheat, cocoa, platinum, you name it. Just about everything out there has an option that you can purchase on there now. These have become extremely popular over the past several years now, and have many instruments out there have very liquid options. So a lot of choices you're going to have. Okay, key option terms that you need to be familiar with. There is in the money, at the money, and out of the money. Okay, when we refer to an option as being in the money, that means that the strike price, the option strike price that you choose, is below the price, the market price of that underlying stock. Okay, and it's the reverse for the put option. It means the put strike is above that market price. And I'll give you an example of that in just a moment. Out of the money is the opposite, meaning the call option strike price is higher than the actual market price of that underlying stock, and vice versa for the put. And at the money means the strike price that is closest to the current market price of that underlying instrument. Okay. Now each option contract can be made up of either intrinsic or extrinsic value. Intrinsic is the in the money amount. So remember the in the money portion that I referred to in this example. Let's say you bought a strike price of 15. That was your option strike, but the actual stock was trading at 25. The difference there is 10. So since your strike price is below the current market price, that means you have $10 of intrinsic value, okay, real value there, okay? Because if you exercise your call option and you purchase that stock at 15, but it's currently worth 25, right? That means you have $10 of real value. Now, extrinsic is the out of the money portion, otherwise referred to as time value. So it's the difference between that option's market price and its intrinsic value, okay? And implied volatility is a key term to know, because this is what helps you estimate the volatility of that securities price. So usually what you'll see is that volatility increases during a bear market or when a stock is selling off compared to when it's going up. When it's going up, you usually have low volatility. When it's going down, you have high volatility. The reason being is that panic that sets in. When something is selling off, people panic, people want to get out of there as quickly as possible. So you see a rush of orders, you see a spike in that implied volatility number, which I'll talk about in just a moment. Okay, so here are a few facts for you. First of all, in the media, you'll hear a lot of talk about how risky options are and can be. Well, they can be risky, but really only if you don't know how to trade them. Once you do learn options and learn how to trade them the right way, you'll realize very quickly that they are much, much safer than just trading stock. And again, I'll show you a couple of examples in a moment. Another fact is that over 80% of those option contracts, be it calls or puts, expire worthless. That's a fact. Over 80% expire worthless. Okay? And most people only buy options without taking fair value or that implied volatility component into consideration. So the traders that really don't understand options very well, don't understand what to look for as far as fair value and implied volatility, and that leads to them buying overpriced options. So what that means is even if they buy it and that underlying stock moves in their favor, they'll still lose money because they overpaid for that option to begin with, and that's a big deal. So here's sort of a layman's way of explaining this, so you can wrap the risk component around in your head. So when you buy an option, okay, only 5 things can happen to that underlying stock. Always, only 5 things. It can go in your favor big time. It can go slightly in your favor. The stock can just trade sideways and do nothing. It can go slightly against you, or it can go against you big time, okay? But here's what it would look like if you had bought an option. If you had bought an option and it went in your favor big time, of course you would make money, right? If you bought a call option, that is. When it went in your favor big time, you'd make money. If it went in your favor slightly, it would depend on whether you make money or not. And what it depends on is that fair value and that implied volatility component. So if you had overpaid for this option, even though it goes slightly in your favor, you would still lose money. If you had paid a fair value price for it, you would make money. Okay? If it goes sideways, you are going to lose money. And that is because of that out of the money component, the time value component in the option. Every day that you hold that option, it gets closer and closer to the expiration date. As it gets towards the expiration date, it starts to lose value because there's less and less time to expiration. So that time value component shrinks with every day that goes by, okay? If the stock moves against you, whether it happens quickly or not, you're still gonna lose money. And if it goes against you big time, you're gonna lose even more, right? So really, when you're a buyer of options, you have really a 4 out of 5 chance of losing money, right? Because you'll make money if it goes against you big time, but if you don't value it properly, right, and don't take into consider that implied volatility figure, even if it goes in your favor slightly, you may lose money, right? So you really have a at best 2 out of 5 chance of making money. So it becomes a little more difficult because with options, not only do you have to guess the direction of the underlying stock correctly, but you have to time the purchase correctly. Now, the strategies that we teach help you with that, and that's where you overcome these odds. But you have to remember that when you're buying options, you have at best a 2 out of 5 chance of making money. When you're a seller of options, the same 5 scenarios can happen. The stock can go in your favor big time, in your favor slightly, really do nothing, just trade flat. It can go against you slightly, or it can go against you big time. Here's the difference. When you're a seller of the option, if it goes in your favor big time, you're going to make money. If it goes in your favor slightly, you're still going to make money. If it goes sideways and flat, you're still going to make money. Why? Because when you're a seller of option and the price does nothing, that time value is still eroding, but this time it's in your favor because you sold that option. Okay, so now every day that goes by that the stock doesn't move, but that option loses a little bit of time value, that's in your favor. Even if it goes against you slightly, you'll still make money. The only way you're going to lose money when you're selling an option is if it goes against you big time. Okay, the difference is in the probabilities. So here's the probabilities versus the reward, or that profit potential. Because remember, when you're a buyer of options, you can only lose what you paid for it, right? So it carries little risk because you are in full control of that risk component, how much you spend on it, right? But your profit potential can potentially be huge, right? Unlimited. As where when you're selling, your profit potential is very small. It's only what you get for selling that contract. That's your max profit. Your risk, okay, your potential for loss can be unlimited because that stock can continue going against you. Okay, so when you're a buyer of options, your probability of making money there is small, but your profit potential is large, okay, and your risk is small. As when you're selling, your probability of profit is big, right? Because remember, over 80% of those contracts expire worthless. That's fact. That's why when you sell an option, you have about an 80% chance of making money. 4 out of 5 times make money, but your reward is small, okay? And your risk can be huge. So those are the trade-offs that you need to be aware of. And here's a little graph that will help you understand the time decay of that time value portion of the option, right? The time erosion. And here's what you should do if you're a buyer of options. So if you're a buyer of options, you should buy as much time as you can. And here, look, if you go 120 days to expiration, okay, in that next 30 days from 120 to 90, you just see a gradual erosion, right? So it really doesn't lose a whole lot, okay? Over the next 30, it loses a little more, but still not overly dramatic. From 60 to 30, even more. But here's where it really accelerates, right? The final 30 days. So if you're a buyer of options, what you always want to plan for is that you are out of that trade before there are less than 30 days to expiration. Because even if the stock is moving in your favor at that point, if there is still time value in that option, it will erode very quickly the final 30 days. But if you're a seller of options, it's actually the reverse. What you should do is sell options that have no more than 30 days to expiration. That way, every day that goes by, you're making money on that time value erosion, okay? So you can go up to 40 days max, but really you should stick to 30 days or less if you're a seller. If you're a buyer, buy as much time as you can, okay? Now, there are dozens of option strategies out there. We're gonna focus on just buying calls and puts, maybe protective puts today, but there are calendar spreads, straddles, collars, butterfly spread, you name it, all sorts of strategies. The key is to understand when and how to use each one, okay? And you don't have to use them all. You don't. What you should do is focus on only 1 or 2 of those. Get to know them really well, and those will be the ones that make you money. Once you learn long calls and puts and protective puts really well, you can then move on to another strategy one at a time. But get to really know 1 or 2 really well and go from there. So let's talk about strategies and how we can actually make money with options. First, I want to talk about, buying Starbucks for less than $1. I mean, way less than the price of a coffee at Starbucks. Let me bring up my chart here and show you what I'm talking about. So here's a chart of Starbucks. Now, we're not going to talk about technical strategies today. Let's just say that here we see the stock moving higher and we think it's going to continue going higher. So we'd like to take advantage of that. But, say we want to buy 100 shares of stock, right? Well, it's trading at over $61. So 100 times 61, that's $6,100 that we would have to spend on that stock, right? Just to buy 100 shares. And if we did that, that would be our risk, right? Because anything can happen with the stock. And we can sit here and say, well, it's unlikely that it's going to go to zero tomorrow. Sure. But what if there's bad news here and it gaps down to 50 overnight? Well, we've automatically lost $11 a share or $1,100. So really, when you're buying stock, the full amount you put in there is at risk. And it's a significant dollar amount usually. But if we go to the option chain here, and let's say we're going to buy options. So we want to go out at least 3 months because remember, we want to be out of that trade before there are less than 30 days to expiration. But we want to give the stock enough time to move in our favor. So we want to give ourselves at least 2 months, okay, of being in that trade. So we're going to go out to April here. And we're going to look at the call options, which is this side here, the left side of the screen. Now, you see how it's shaded yellow here, but then these strike prices are clear or white. And here are the strike prices, by the way, this row here. So the yellow or the shaded area are the strikes that are in the money. And these are the ones that are out of the money. So if you see here, a 60 strike is $2.97 to $3. We'll call it $3 for easy math. But the stock is at $61.28. What does that mean? That means that a portion of this $3 of the premium is in the money, and a portion is what we would call, in the money, otherwise known as intrinsic value, and the rest of it as extrinsic or time value. Because we bought 3 months of time, 91 days to expiration, there's a time value component built in. So the true in the money or intrinsic value, right, is the difference from your strike to where the stock is trading right now. Your strike is 60, the stock is trading at 61.26. That means there's $1.26 of intrinsic value. Because if we were to exercise this and take over the shares at 60, we could sell it for 61.24 now. That means there's $1.24 of instant value, right? The remainder, the difference from that $1.24 to $3 is the out of the money portion or the extrinsic value, otherwise known as time value. And that's the portion that will slowly erode over time as we get closer to expiration if the stock doesn't move and goes flat, okay? If you look at the 62.5 here, that is all made up of extrinsic value, all time value. There is no in the money portion there because the stock is trading below that 62.50, okay? But let's say we wanted to buy shares of Starbucks, but we wanted to do it for less than $1. Could we? Well, if you go to the 65 strike, you can pick some up from what, 82 to 88 cents or so, right? Now, if you bought one contract, that's the equivalent of 100 shares. So it'd be 1 times 100 times 0.88, which means what? It would cost you $88, right? $88 for one contract, right? Which is the equivalent of 100 shares compared to $6,100 for the stock. So this is what I mean by limiting your risk. right? Now, if the market ceases to exist tomorrow, right, or Starbucks goes to zero overnight, right, the max you'll ever lose is $88 compared to $6,100 that you could lose the other way. So it's a significant difference. Now, you know, obviously, without getting into too much technicals, the delta component here on the option, if we're buying that one, is 26, which means if Starbucks goes up $1, we're going to make about 26 cents profit on this, right? So for every dollar it goes up, we make 26 cents. But that's a moving target. If it goes up $1, then that means the delta is going to increase. It'll probably go to 30. So that next dollar would be 30-cent profit, etc. So you will make more money, you know, in the near term just by buying the shares than you would the option. But the amount of risk is significantly different, right? And that's a bonus. But now, if we think of, if we buy that option, right, and the stock actually goes against us, that means we're going to lose money. But can we repair that trade? Your options are limited from that perspective when you just own a call, an inexpensive call that way, that's fully out of the money, and the stock goes against you, and you're also losing that time value component, right? It's very difficult to repair that trade. We can average down and hope that the stock will go back up, but that's usually a losing strategy. A different way we can do it is where the puts come in. So let's go back to buying the stock at 61.24 here. But this time, we're going to buy the 65 puts. Now, it's going to cost us $460 to $470. So in total, if we buy the stock for 61 and change, and we buy the put option for 470, let's say, right? In total, that is almost $66, like whatever, 65.80, or that sort of thing. In total, that's our total cost. But what is our total risk? Our total risk is equivalent to what it was on the call side, because our cost is 65.80, let's say, for round numbers, but we always have the option of exercising it and selling our option at the strike price, which is 65. So the difference from 65.80 to 65 is our risk, which is still only about 80 cents or so, right? So the difference here with doing that, if you have the capital to buy the stock and the put, is what you can do in case it goes against you, right? Or even if it goes in your favor, how you can adjust this trade to make even more money. When you own the stock, you can sell a call option against it and bring in more premium, right? If it goes higher, if the stock goes higher, these call options are going to appreciate in value. So if you buy that initial position and sit and wait, and the stock goes higher in your favor, not only will you make money immediately because it's gone higher, but you can then sell a call that will be more expensive than it is now against it and collect even more money. Okay, you can also roll down your put position. Okay, so now Starbucks isn't a great example for this adjustment. The higher price stocks obviously will be even better for this. But if we look at this, let's say that we wanted to get out of this stock now, you know, at a slightly better price or less risk, we can roll it down. In other words, if we sell this put, the April put, which still has 91 days to expiration, okay, and we collect about 470, and we go to a near-term expiration, which doesn't have as much time value in it, okay? Let's go to next week's here, and we look at what strike we can buy with 470, okay? We now can the 65.50 strike is 445 to 555. So we could pick up that and now have the right to sell it at 65.50, okay? And even make 20 cents on that sale, because we sold it for 470. We're only buying it for about 450 here, right? So now, remember, our cost was 65.80 in total. We've made 20 cents from the sale. We've brought that to 65.60, and now we can sell it for 65.50. That means a risk of 10 cents now, right? And that's how it works. So, and it's even more dramatic on the the Teslas of the world, Netflix, or any stock that's really moving rapidly. When you go from a longer term expiration to a shorter term, you can really jump and strike because of the reduced time value component. So it's a really, really neat strategy where you can set this up where you have a very small amount of risk to begin with, and still give yourself that profit potential without worrying so much about the downside. And if it goes against you, you can then repair that trade, or even if it goes in your favor, you can bring in even more money. So that's the one thing you're going to find with options, and especially when you get familiar with the other strategies, the more advanced strategies. What options do is they give you a lot of options, okay? You can do so much with them at a very small amount of risk. So whether you're trading with a small account and you're just buying calls, or whether you're trading with a bigger account and can afford the combination of stock and puts, it's very, very safe, much safer than just owning stock. And it gives you a lot more flexibility of how you can manage that order throughout the life of that order, okay? Now, the other strategy that I want to talk to you about here is let me go back to my slides, is trading earnings season, because a lot of people see big gaps on stocks after they announce earnings and immediately start to think, well, if I buy a call option for 80 cents, but then the stock gap's $10, boy, could I make a lot of money with a very small amount of risk, right? And there's some truth to that. Here's the challenge. So it depends on how you do it. Remember that implied volatility figure that I talked about earlier, and whether or not you are overpaying for the option. That's really what making money during earnings season really comes down to, okay? That's the whole difference. So let's look at Netflix. Netflix, I believe, comes out with earnings on Tuesday or so of next week, I believe. So a couple of days from now, a couple of trading sessions from now. So what most people do is they will buy a call or a put option, or both, the day before the earnings announcements or the morning of, if they're reporting after market close, right? Hoping for that big gap one way or the other and make a ton of money. Here's the challenge with that. And if you're a Thinkorswim user, all you need to do is go to the trade tab here, which gives you the option chain. And if you close all the option series here, and you look to your right, you have these percentages beside each of the expiration dates, right? Each one of these lines here, these months, is an expiration date. And the percentages on the far right are the implied volatility figures. Each stock has an average. So if you look at Starbucks and you look overall down the list, it's really high 30s, low 40s is the average. So we'll call it, for easy math, 40% implied volatility is the average. So if there isn't any news or any event coming up on the stock that people are anticipating will cause a stock to make a big move, so on, generally it will sit in and around the 40% implied volatility. So if you ever see it dip below 40, that means, and you buy that option, you're buying at you're an undervalued option, right? You're getting a deal on it. You're getting it on sale. If the implied volatility is higher, that means you're overpaying for that option if it's higher than the 40 range, right? So if we look at next week's expiration here, which expires next Friday, 7 days from now, the implied volatility is already at almost 68%. And as we get closer to that date, this is going to spike. And it's not uncommon to see this go over 100%. So let's say that by Tuesday, this will be at 100% or even 80%, okay? But the usual is 40 for this stock, okay? What happens is you go in the day before earnings or the day of and buy a call or a put expecting that big gap, and you're overpaying. You're paying twice as much at minimum because this will get to 80 or more, probably 100, okay? You're way overpaying. And then as soon as that earnings announcement is released, this implied volatility percentage will fall back in line with the average, which means if this was at 100 when you bought it and they release earnings Tuesday after the close, when the stock opens Wednesday morning, your option contract, the implied volatility will go from 100 back to the 40 range, which means you'll lose 60% of the value of that contract immediately, right? So even if it gaps in your favor, you're losing 60% of the amount you paid for that contract immediately, right? Regardless of what the stock does. And that's why most people lose money that way, okay? So the real advantage here to trading earnings season, or one of the ways you can put the odds in your favor, is to give yourself time leading up to that earnings date. So generally, stocks will see a spike in implied volatility about 2 weeks before earnings. So it'll start about a week and a half to 2 weeks before and just build into that earnings date. So if we go back and look at the chart here of Netflix and look at the previous earnings date back in here, which was October 16th, okay? If, using one of the strategies we use, and it doesn't matter what strategy you use, but what you should do is mark that earnings date ahead of time in your journal. And then a couple of weeks out, 2 to 3 weeks out, start looking for a proper setup according to your strategy. So here was one on ours, which happened October 4th. Remember, earnings date was the 16th. October 4th, we had a trigger to go long. And here's the advantage here. First of all, as we go from the 4th to the 16th, we're going to see a spike in implied volatility. So even if the stock did nothing and went sideways on us, the value of that option contract would increase because it would go from that 40% implied volatility spike to 50 to 60, 70, 80, 100, who knows how high it's going to get leading into earnings, right? So we'll be making money regardless based on that implied volatility spike. It's not a guarantee because if the stock goes against you, you'll still lose money. So I don't want to give you the wrong impression, but it's in your favor, right? As where usually when you buy an option, if the stock goes flat, you're losing time value, right? Here, because of the implied volatility spike, it's going to increase in value. Now, if the stock moves in your favor based on your technical setup or your strategy, you're going to make even more money, right? So the key is to buy a couple of weeks out, right? Only if you have a proper setup, that is, and then hold it until the day before earnings, and then get out. Get out before that earnings announcement, or maybe sell part of your position and and maybe hold some contracts to see if it gaps in your favor even more. But remember, the key is that if you were buying here, you don't want to buy the 1 week expiration, right? Because that's the one that would be inflated or start getting inflated, right? So if you want to hold it longer, you go further out. If you want to take advantage of that implied volatility spike and get out before earnings, you buy the one that expires right after earnings. So this would have been the one like this one. I would have had about 21 days to expiration at the time, right? just make sure it's the expiration that happens right after that earnings date to take advantage of the implied volatility spike. If you plan to hold through earnings, you want to go longer out, the one that does not see that spike. Okay, makes sense? And let me show you another example quickly, right? 3M, here's their previous earnings announcement, right? Happened here. But what happened a couple of weeks before? Here's that setup leading into it. The other benefit here is that if you buy and the stock starts going against you, right? If it goes against you slightly here, you'll still be okay because it's still going to experience that implied volatility spike as it makes its way through earnings. So that increase to the premium via the implied volatility spike will overcome the loss because of the stock dropping slightly. Okay, so it's a real advantage. So what you need to do is mark that earnings date ahead of time on your calendar, and then look for that proper buy or sell setup about 2 weeks before, and just plan to be out before that earnings day, because that, it can gap either way on you. There's no easy way to know unless you have inside information on which way this is going to go. So, and through the life of that order, through those 2 weeks, if it jumps up significantly, you can take profits right away. There's nothing stopping you from selling out at a profit before you get to that earnings date. You want to be out before, but you don't have to hold it all the way to that date, is what I'm saying. So you can treat it like any other order, but you have the advantage of knowing that that implied volatility spike is going to add value to that long option contract that you're buying. Okay. Now, as I said before, options really give you many, many ways of making money. There's so many different strategies, right? And what we've done is put together a course called the Crush the Market with Options class. If you go to tradingwins.com/crush, it'll take you to this page that will list everything that's in this course. It's about 2.5 hours. It's an on-demand recording that's yours, and you can watch as many times you want from anywhere. And what I'm going to teach you in this class is I'm going to elaborate on what I talked about today. But in addition to that, I'm going to get into the more sophisticated option strategies. And I'm going to show you a quick and fairly easy way of earning a steady weekly income using credit spreads. That's when you're selling those high probability options and collecting some premium week over week. Also, I'm going to show you how to trade butterfly spreads. And these are great because your risk is very, very small, but usually the profit potential is about 9 or 10 times what you spend. Okay. This is a very, very interesting strategy that I will teach you. Also, during times when the markets go completely silent, there's, 3-4 times a year where the Dow, the S&P, the NASDAQ will just kind of flatline for a month or two. And that's where these delta neutral strategies will allow you to make money no matter what happens with that stock. When it's going flat, you'll still make money. Okay, and I'll show you how that works. More importantly here is I will share a couple of repair strategies with you. So no matter what kind of trade you put on, if it doesn't go your way, these will help you repair part or all of that. Okay, and in addition, we'll throw in a bonus, a 30-day membership to our Trading Wins Pro membership. What that entails is you'll receive videos from me 5 times a week, every Sunday to Thursday evening. I'll send you a video recapping what happened in the markets that day, where things are going. That's also where we share some trade ideas. Also, you'll be able to join us twice a week for our live market chats, where you can come into our room and ask me any trading related question you like. It can be on options, on this class, on anything you want. And once a month, we do what we call a course of the month at no extra charge for our pro members. So that one, and actually we're having one this afternoon at 1 p.m. As well as the next course of the month. So you get all of this for just $7. We usually like to offer a real strong deal here for the folks at Investor Inspiration because they've had us on so many times. They've been such a great partner. And trust me, you're getting a lot more value than $7 here. This is not a moneymaker for us. What we want is for you to just see what we do here at Trading Wins. We think you'll really enjoy it and be able to learn a lot, and we hope you take advantage of it. So it's tradingwins.com/crush, and just click the green button, get it now, and you'll be all set. I think I'm out of time. So if there are any questions at all, you can always send me an email at info@tradingwins.com.